Hello and welcome everyone joining live and those viewing the session during the Minds and Money roadshows happening globally through the month of May. Very pleased to be here today to talk about the impact that ESG is having on M&A as we see the topic of ESG getting increasing profile both in media and among stakeholder groups. Just before we kick off, my name is Mike Pickersgill and I'm the co-head of the mining practice at Torys LLP, a leading law firm located in Toronto and throughout Canada and New York. To discuss our topic today, we have a very distinguished panel put together. I'm very pleased to introduce them now briefly, and then we'll kick into a bit of a discussion on the topic. First, we're joined by Annie Markova. Annie has been a portfolio manager investing in the metal space for more than 15 years. She's currently a corporate director with Golden Star Resources and Silvercrest Mining. She's the chair of the Safety, Environmental and Social Sustainability Committee at Silvercrest and a member of the Corporate Responsibility Committee at Golden Star. She's the founder and CEO of Investor View Advisory, engaged with public companies on ESG reporting and integration. And I'm guessing we'll hear a little bit more about that during the course of the discussion today. We're also joined by Mike Akkooi, who is the Senior Vice President and Global Government Relations with Kinross. Previously, Mike had various international roles at BHP, both in respect of minerals and petroleum activities, located in Singapore, Melbourne, and the United States. Aidan Davey is the Chief Operating Officer of ICMM. As the COO, he is responsible for strategy and development and implementation. He also leads ICMM's work on environmental issues, including the management of issues related to climate change, mine closure, tailings, and water. Aidan has over 30 years of cross-sectoral experience on sustainable development issues, including the World Bank and the International Finance Corporation in Washington. On my right is Ian Maxwell. Ian is an operating partner at Pac Road. He's a senior mining industry executive and has over 30 years of mineral industry experience in the equity markets and working both with greenfield and brownfield exploration. He was previously president of BHP Coal and BHP Exploration, and he has developed a deep experience in his work in developing and operationalizing strategies around corruption, human rights risks, indigenous rights and participation, and environmental management. And last but not least is Julian Trager. Julian's the CEO and executive director at Anglo Pacific LLP, which is a listed LSE company. He's also served as one of the principals of Audley Capital Advisors, an investment advisory firm, which he co-founded, and which manages value-oriented and special situation investments throughout the investment cycle, and has a principal focus on the natural resources sector. Julian is also a director of Mantos Copper. So, having assembled such an august panel, I wanted to just kick off with maybe a little bit of an introduction of the topic. I think ESG in its various forms and names, whether that's environmental stewardship, managing the vital social license, the S, governance, those have always been mission critical for operators in the mining sector. And as a result, by virtue of that, managing that in the context of an M&A transaction, planning for an M&A transaction, and successfully executing an M&A transaction has made ESG always fundamental to the M&A process. But we now see today ESG issues writ large becoming very much a headline matter, not only an operational matter for miners, and not only a headline matter when particular issues related to ESG matters rise up and become significant problems for operators, but it's also become a headline issue in terms of regulatory focus, in terms of investor scrutiny, and generally the focus of financial stakeholders, including lenders. And that focus, is being talked about by investor groups, and you even see large institutional investors being very clear now that they will benchmark investments against ESG standards. And so I think the real question for this panel is, with the backdrop of that focus and the backdrop of that concern is to think a little bit about how ESG focus is affecting M&A in the mining sector, where it plays such a pivotal role. So I thought maybe to kick it off, I could turn to you, Annie. You are, as I mentioned, a director on a couple of corporate boards, playing roles on the key committees in this respect. And you were an investor, an institutional investor in the mining sector for a long time. How do you see this ESG theme and investor sentiment playing into M&A strategy, and how a board member thinks about that when they're thinking about their stakeholders?
Yes, thank you for the question, and hello to everyone. Boards have fiduciary duty to protect company assets, and thus considering financial risks associated with climate change or other environmental and social factors. Through policies and incentives, boards design the appropriate governance frameworks, as well as oversee the integration of risk mitigation practices. Mining companies balance natural capital, human capital, social capital, financial capital, and intellectual capital to produce the metals which become the manufactured capital that are broadly used and fundamental for the advancements of our society. For our industry, M&A is a necessity and not new in strengthening the natural capital, for example, from a reserve and resources point of view, as well as the human capital skills, the know-how when unlocking opportunities. As an example, a transaction comes to mind a few years ago when Pan American Silver acquired Tahoe Resources. Those two capital components played such a vital role in this transaction. And now the skillful team at Pan American continues to unlock opportunities at Escobal. What is new today, I believe, and very fast changing, but can dramatically impact the valuations during M&A, is assessing the climate change costs and opportunities. It is very clear that Build Back Better has set out goals of where we're headed, and the UN SDGs are the blueprint of that. Climate change commitments, regulations, taxation around the world is having a real financial impact on our businesses. Assumptions made based on scenario analysis of temperature changes according to the Paris agreements for planning and valuation purposes are impacting the assessments of assets and liabilities on our balance sheets. Within the next 6 to 12 months, we will receive the IFRS's guidance on how to integrate such assumptions within our financial systems, which will level the playing field a bit, and we will have clearer understanding of how to value transactions. From a board perspective, it is our fiduciary duty to think about the long-term sustainability of the business models. And in this fast evolving socioeconomic environment, consider M&A as a strategy for diversification and leveraging our internal human capital skills. The proper understanding of risk mitigation of such environmental and social impacts could only lead to improved availability and cost of capital, which is critical for the success of any M&A transaction. And I'll leave it at that. Perhaps some other members could comment on that.
Well, thanks, Annie. And Mike, maybe I'll turn to you just for a moment as a follow-up. As an officer focused on these issues at a Canadian public company, how does the shareholder focus on ESG, from your perspective, impact M&A as you see it in your role, and the ability to get deals done, given some of those concerns that Annie raised?
Yeah, well, listen, let me start by just saying that I think for the mining sector, ESG is an area where they've been leading the world for a long time. When I joined BHP back over 12 years ago, and when I was working with Ian back in exploration, the company was already developing all of these mitigation frameworks on environment, social governance, assessing the risks for M&A transactions back then. And I think today it's become more sophisticated, it's become broader, but it was always focused on license to operate, your ability to actually operate the assets. What's changed now with the ESG focus is that the pivot has become from operating the asset successfully from an environmental, social, and governance perspective, but also shareholder expectations and governance expectations and implications of importing a project into your portfolio for your investor landscape. That's something that's quite new. I would like to echo also what Annie said. I think climate change, greenhouse gas emissions, is probably the leading factor that many ESG shareholders are looking at. And I would even argue that maybe they're even confusing ESG as basically just meaning climate change and environment. And it's early days for us still within the company when it comes to thinking about how these new metrics are impacting our M&A opportunities when we're assessing them. We just went through an assessment for an opportunity which we're not pursuing, not because of ESG, but we actually started the discussion about, well, what is this going to do to our greenhouse gas emission numbers for the portfolio and the company? Is it going to put us back, or how are we going to mitigate that? So it's starting to be incorporated now into our thinking. But it's really like almost the next phase, I would say, in this trend.
And is this a new hurdle for deals? I mean, maybe Ian, coming at this from the perspective of private equity for a moment, but obviously you've seen this in a number of different roles and contexts. Stakeholders of all kinds are looking at these issues the way Mike just described. And creating that pressure. Does this make it harder to get deals done?
Look, it's the first thing to say about private equity, Michael, is our investors have listed equity investments, they have funds, they have a basket of things they invest through, and private equity is just one of them. So we're very beholden to the same ESG requirements and standards as listed funds and other things that you would see. So don't expect anything different in the PE world. There is one exception to that, which actually deepens our interest in this, which is we tend to be a very concentrated investor. So we might own anything between 30 and 100% of a company. We might have a very limited number of companies in the portfolio. And of course, what that means is the specific risk of any investment going bad is obviously higher, and you can't rely on the portfolio. So we do, in a PE sense, therefore, dig probably a little bit more deeply, more like a corporate, perhaps, more like what Miguel and Kinross would do as we look at things. I think from our perspective, what we see is we've got the traditional investors that invest with us, and they're broadly comfortable with the risks. They understand them. But it is safe to say that new investment is scared of investment in the mining sector. They're scared of the commodity risk, the technical risk, the capital management risk, the ESG risk. You compound it up and it becomes fairly substantial. I think there have been numerous high-profile failings in the sector. You can think about the Brumadinho tailings failure. You think about the failings of companies in corruption in West Africa. Investors don't want to be on the front page of a newspaper being invested in a company that's there. And I think a lot of investors ask, do we really need to be there? And so I think one of the things for us as in the PE world is really demonstrate that the companies we invest in can perform to leading ESG standards. And as Mikael said earlier, and I couldn't agree with him more, the big companies in this space, whilst they've been sidelined a little bit, I think, by tailings and indigenous rights, and we've seen that, across many of the other areas have been pretty good for a substantial period of time now. Where we invest in the mid-tier, that's catching up, and I think there's still a bit of work to do there. The reality is, though, there is a need to invest in the sector. If you think about the decarb, we spoke about, a couple of people have spoken already about climate change. If you think about decarbonizing and think about the commodities that will enable that to happen, it's going to require investment in the mining sector, and it's going to require investment in many mid-tier companies as well as larger companies. So there is a need. There is substantial growth there, which creates a value proposition. And I think our job, whether it's in the companies or whether it's in PE or listed funds as agents of investment into the sector, is to demonstrate to investors that those risks that sit under the ESG category generally can be managed and managed very well. and I think they can. I think there's a track record of good performance in the sector as well as bad.
It's interesting. I want to touch on two themes you mentioned there, two themes that have been mentioned, and folks have mentioned climate change as being a bit of climate change or GHG emissions, those issues becoming a little bit of a proxy in some ways, or absorbing some of that attention, and as well questions about how investors are looking and thinking about investments. Julian, from your perspective with Anglo Pacific, your firm has recently completed a significant investment in the cobalt sector, in a cobalt investment. How do you see that as a driver? Do you see that as something that's driving strategy in your thinking and your portfolio? Does that resonate with you?
Yes, I think definitely, Michael. I mean, obviously people are more concerned about ESG, but I think as long as you don't have real problems on the E and the S front, this is an enormous opportunity for our sector. I think it's something to be pay attention to, but it's going to really create a lot of very exciting opportunities. I think our sector is going to shift from being a sort of backwater industrial revolution, belching coal thing from the 19th century to being an integral part of the green future of this planet, and key to it. And so we're moving from being part of the past to being part of the future, and that's going to throw up enormous opportunities. And also in terms of the integration of technology, the reformatting of many processes to work out, coal. I think there are great opportunities thrown up by this, but obviously we need to make sure that there are not problems. And yes, for Anglo Pacific, going from coal to carbon, which is from coal to cobalt rather, which is the route that we're on, is a great opportunity for us to pivot and get more attention from ESG focused investors who are interested in being part of the future.
And have you seen that kind of reaction in the response to the transaction?
Well, we have had a lot of positivity from the institutional shareholders, and a transformation of this nature. We haven't seen it yet reflected in the pricing of the stock, but we're out selling our story, and hopefully that will happen over time. And we did issue quite a lot of stock, so that needed to be absorbed.
Right. I wanted to maybe pivot now to discussing a theme that's come up a couple times, which is the opportunity presented here. And we'll have to turn ultimately to ESG as a risk, and how that needs to continue to be addressed as a headline matter or a key matter in M&A transactions, particularly given the attention on it. But before we do that, thinking a little bit about the opportunity theme and just wanting to pursue that a little bit, because I certainly hear a couple themes coming through, really about a whole new area for potential synergies in terms of how firms can look at M&A as an opportunity and potentially as a driver. And maybe Aidan, just to turn it over to you for a moment, thinking about ICMM's view and role in the industry, its broader view, do you see this as an opportunity as well?
Yeah, thanks, Michael. And look, I think as a number of the other panelists said, for many years, ESG factors have been a consideration in M&A transactions, but they were exclusively looked at through that risk lens. And I think probably the concern started with environmental liabilities like contaminated land, with potentially significant cleanup costs, and especially after many mining companies found themselves the owners of unanticipated liabilities, such as closed sites with ongoing significant liabilities that may have received scant attention in M&A due diligence reports. So they've been growing in importance in M&A activity, as others have said. But can it be, can ESG be a driver of value? I think absolutely. And one key consideration for companies involved in M&A activity concerns the issue of integration. And that includes how ESG performance is going to impact on post-merger integration. So as you know, you will know very well, speed's of the essence if synergies are going to be achieved and value is going to be captured. And if you've got companies on either side of an M&A transaction that have got widely divergent approaches to ESG issues, that's going to be a problem when it comes to post-merger integration. Conversely, where both companies involved in an M&A deal have high standards of ESG performance, integration is likely to be much more seamless. So I think sound ESG performance can be a driver of value by giving confidence to the parties involved in an M&A that a project's going to meet both stakeholder expectations and regulatory requirements in the future. And to a degree, ESG may in and of itself be a driver of M&A activity in mining, and perhaps Julian's touched on this, especially if it means securing access to a pipeline of metals and minerals that's going to support that transition to a low carbon economy. And it can also be a driver of M&A activity as companies look to secure long life assets that exhibit the desirable characteristics that, from an investor perspective, and that they increasingly expect to see. And just at the beginning of this year, we had PwC and their Tracking the Trends report talking about the key criteria that mining investors are looking at when it comes to seeking M&A financing. So it's comfort around a company's ability to deliver stable dividends over time. You need to have that cohesive, compelling growth story, and critically, you've got to have sound ESG performance. And investors are pressing harder for more detailed information about companies' ESG risks, their targets, and how they're tracking against them. So yeah, I think ESG factors are a key consideration in both value, but also potentially in driving M&A activity.
Annie, do you see a role for synergies here and value?
Absolutely. As I mentioned, I really think that leveraging expertise in the industry in the various parts of the world and the various fields, this is critical. This is an effort to improve the performance of companies themselves, to look for optimizations, to look for doing things better. As someone smarter than me once said, that 80% of the risk could be captured by 20% of the efforts. I think that this goes well ahead of working together, either through M&A synergistic acquisitions that will put perhaps asset-rich companies with capital-rich partners or skill-rich partners to create a new entity that will be a lot more attractive and will perhaps diversify all the risks and look for new improved opportunities. A very big component, for example, of the environmental cost is now the carbon cost. But solution to that needs to be in new sources of energy. So we cannot solve the decarbonization of the mining industry without talking about how are we going to improve the energy sources or water sources. And so this brings a lot of conversation about the community impacts, and variety of parts of the world have different challenges. Can those be leveraged? Can that be integrated? And again, looking for capital efficiencies as to what investments today can lead to improvements, looking for the new technology, perhaps that we haven't thought before. And again, I come back to the people. We need to attract more diverse group of younger technology capable people into this industry that will help us solve for all these challenges, because we need to look for them as opportunities to improve the returns to all the stakeholders.
Julian, any thoughts?
Well, I think, first of all, I am seeing sort of a bit of an explosion of new thinking and technology driven by these ESG concerns, which I think will fundamentally alter the complexion of the mining sector in the next decade. I think it's very exciting. I think we are, as part of the future, we're becoming more Silicon Valley like. And as we see the breakdown of the commoditization of commodities and becoming more, going from a B2B to a branded consumer, I think there's going to be a lot of opportunities. But the really exciting thing from an M&A perspective is the way in which the cost of capital is reducing for greener projects. I mean, you've got green bonds. We as Anglo Pacific are looking at ways in which we might charge differential rates for our royalties depending upon the counterparty's progress in becoming greener. So you're going to have, on the one hand, coal, you can't get insurance for, you can't get banking for. It's really being starved. But on the other hand, the green commodities or the more socially responsible operations will be able to access cheaper funding, and that will drive the M&A process.
Does this maybe impact the other side of the M&A equation? Maybe I'll turn to Mike and Ian for their thoughts on this one. But, thinking about it from the perspective of operators, smaller operators, mid-cap operators, folks who might be thinking about asset operations and an exit, project developers. Does that cost of capital point have an inflate? The flip side, Julian, where the cost of capital now is more expensive for those who don't have the resources to put into ESG or protect, or as Annie's saying, the skill set to get the things like government relations right. Does that essentially impact this? Where on the sales point folks are looking to exit operations from a developer and explorer perspective? Mike, any thoughts on that one?
Yeah, I mean, there's a huge amount to unpack here and some of the stuff that everybody shared, but I'll try and keep it focused. Look, I think from our perspective, when we go and look at a project for an acquisition or a merger, you're looking at the quality of the resource that's there. You're looking at the price point that the seller is looking to sell it for, and then you're looking at all the above ground, let's call it ESG stuff, right? And if there's no good resource there, it can be the greenest project in the world, we're not going to buy it. If the price expectations are too high and there's no value add for our shareholders, we're not going to buy it. And then finally, if there's all these social and governance problems with the project, we're not going to buy it. And I think, in our pre-call, I mentioned that about 30% of the projects we discount fall over on ESG grounds. And unfortunately, I think many of the junior companies that are trying to develop a resource and then sell it to a developer producer at that stage lay the groundwork for ESG, but don't necessarily have all the resources to do it properly. And while I completely agree with what Julian said about how ESG is exciting, it's driving new thinking, it's changing the industry, it's pulling us out of the Flintstone era into the Silicon Valley era, which I think is really important for public acceptance of the mining sector. There's also an increased cost in actually doing ESG properly, right? And managing all the community expectations and the government expectations and the environmental things, particularly if you're buying an operating asset versus something that you're going to develop from scratch and introduce new technologies from the beginning. And I'll just round off by saying that while strategically for the sector, I think ESG is pushing us in the right direction, I still think that it's not a huge value driver at the end of the day. It's a value destroyer if you get it wrong. So there's not a huge amount of upside. There's a lot of downside if you don't get it right, and you don't get access to capital, or people don't want to work for you, or you won't get your permits, or the shareholders are going to be upset. And so it's almost becoming like raising the bar on table stakes to be an acceptable mining company, as opposed to saying, I'm going to have a 10% share price bump because I'm a better ESG performer than the other guy. I'm not sure we're going to see that necessarily in the short term, at least.
Ian, any thoughts from your end?
Yeah, look, like Michael, there's a lot to unpack in the questions, and I was trying to make some notes as we went through. I want to start with something Julian said, which I agree with 100%. the mining sector is a positive contributor to society on average. If we go back and look at the Millennium Development Goals and we think about the urbanization in China and how many billions of people have been brought out of poverty and the role that metals and the things that our companies produce have had in that, it's been a substantial contributor. We're now at another inflection point when we start to think about reducing greenhouse gases and energy transition and energy transformation. That is going to be impossible without substantial increases in commodity production. And it really doesn't matter whether you're producing cobalt or coking coal. It's really hard to put up a wind farm if you don't have steel. And so, this sector does have a huge positive contribution, and we should just, sometimes we underplay that when we talk to people. You can see a world, and again, picking up on something Julian said, you can see a world where technology makes a difference in all sorts of ways. And I think picking up on his theme, I can certainly see a world where I go and buy, my next BMW and I choose a Bang & Olufsen stereo red paint and sustainably produced leather and green copper. And they're all on the tick list of options. And I think the companies that are able to supply into those supply chains and have the ESG credentials to do so, and ultimately the technology through blockchain and other things is coming to track that, you will see a decommoditization in commodities, a fragmentation perhaps in the way that you used to see in the bulk commodities, where certain commodities, certain qualities had a premium, certain had a discount. You may even get to the point where certain people can't sell their material if they have not met certain ESG criteria down the route. So that is both an opportunity and a cost. And then the third piece, coming to the piece that Mikhail was talking about, which is really around management of the assets. For me, the issue is a materiality framework and managing the material risks. I think the industry has done a great job of worrying about slips and trips, and we see really great health and safety performance across many companies now, right down in the mid-tier and junior sector. Certainly, if you compare it with things like construction and other sectors, it's a very, very good performance. Where we're still missing a beat, I think, is on material risks and a leadership and culture that says, let's focus on the material and let's manage these things really, really, really well. And whether it's BHP and Vale, or whether it's Rio Tinto, even the big companies are not getting this right yet. And I think that's scary to investors. So my counsel is that's one area we need to focus attention. The other, and it's inexcusable, is disclosure. I mean, the disclosure of the big companies now is really very good. The disclosure in the mid-tier and the juniors is still very, very, very mixed. And there's no reason for that. I mean, there's absolutely no reason. The frameworks are out there. I'm going to put a plug in for Aidan here and the ICMM and Tom Butler and Aidan and his team. There are so many tools sitting within the ICMM. They're absolutely world-class. You don't have to pay. You can tap into them. There are great frameworks out here. And yet I look at some of the companies we want to invest in, and some of the disclosures are not worth the paper they're written on. And that is scary. And so when I go and try and attract money into Pacific Road and say I want to invest in this company, that stuff is just not helpful.
And that's a great segue to thinking about the issue a bit from the junior perspective, and how from their perspective there are challenges in I think, and one of the points, both in terms of how one assesses it, thinking about a target, or as a junior managing and stewarding your asset, is that issue of standards, Ian, and disclosure. And Aidan, maybe you take a minute and just, as Ian introduced, describe some of the work that's being done in that respect, and ICMM's toolkit, and what's available for companies thinking about this in the context of M&A. I mean, whether it's a value driver or a value destroyer, either way, it's got the cost of capital repercussions that Julian mentioned. And so mining operators of all sizes need to be thinking about it.
Yeah, and Ian, really appreciate the shout out. Look, I think standards have an incredibly important role to play when it comes to establishing normative expectations around ESG performance. And there's a couple of different facets to this. Firstly, it's what are the ESG issues that we expect responsible mining companies to manage effectively as part of their day-to-day operations. But and then they become important considerations when it comes to M&A due diligence. And the second, I think, is around what level of performance do we expect responsible companies to adhere to in each of those issue areas. And we gave a great deal of thought to this when we developed our strengthened membership requirements and launched beginning of last year our ICMM mining principles. And those mining principles define good practice ESG requirements for the industry through a comprehensive set of 38 performance expectations that sit beneath 10 overarching principles. And what we're looking to do through that is, seeking to maximize the industry's benefits to host communities and minimize negative impacts on issues of concern to society. Now the principles include really clear and specific requirements that members are expected to conform to. So, under Principle 3, you've got the things relating to the UN Guiding Principles on Business and Human Rights, Labour Rights, Resettlement, Indigenous Peoples, Gender and Diversity. Under Principle 6, we cover tailings management, closure, water, climate change and pollution abatement, and so on. But in each of these areas, the key thing is that the principles give really clear, unambiguous statements, of what companies, either should do or what they shouldn't do. And up until now, the main vehicle for members to demonstrate their commitment to membership has been through their annual sustainability reports, which do provide I think a pretty good, but a corporate level overview of performance. Because these principles apply down to the asset level, and the disclosures that members have committed to give customers, investors and other stakeholders line of sight right down to the asset level and the quality of management across all of these applicable performance expectations. That's kind of a game changer in terms of putting information out there. And while these are designed for members, we absolutely encourage others within the industry to embrace and implement them. It's all open source. There's nothing here hidden behind a paywall. So I think establishing clear standards of ESG performance can really help set those normative expectations for the ESG issues companies should look at in M&A transactions.
Can I just jump in there?
Sure.
I think, I completely agree with everything that's just been said. I would, though, flag that, one of the challenges we're facing as an operator in the sector, and I think the juniors will have that too, is the number of different standard setting organizations that are out there, right? So we have ICMM, which is doing great work. In the case of the gold sector, we've got the World Gold Council, which has its responsible mining principles. In Canada, we've got the Mining Association of Canada with its Torys Sustainable Mining Program. And then we've got, I was on the steerco in our ESG steerco in the company yesterday. And I think we're participating about 8 different ratings agencies for ESG ratings for the company, right? And that's quite a bit of overhead. There's quite a lot of decisions to be made as to which standards do you want to meet. They're not all recognizing each other. And so I think for the junior space as well, there's going to be there's a bit of a challenge there to figure out what can we meet and how much resource can we dedicate to doing that.
If I might jump as well on this thought process, in addition to the industry-specific standards, we do have now a massive effort on a global basis being done through the merger now of SASB and IR to create the Value Reporting Foundation. So in very short period of time, we will actually have a more simplified definitions and reporting disclosure requirements, and merging those with the industry-specific requirements. I think that's where most companies will find the sweet spot of simplifying and prioritizing disclosures. And in efforts to simplify this for the junior mid-tiers, now there's tools like the Onion ESG software reporting system, which really simplifies it all and says, juniors, you really need to focus on the most material information and the basic data that will help you better manage your operations. So I think there's no excuse now for all companies of all sizes to put out the relevant information that investors are requiring to make decisions. But also as board members, we do want to know what's happening on the ground. And that only happens if we capture the right data, if we see the trends, if we could put governance structures and policies around how to manage those issues, like water stewardship, like community engagement, like improving local supply chains, and so on and so forth. So to me, this is like an evolution. Standardization is coming. And what we need to do is start collecting the information and start reporting. I think this information and the availability of this information will be very critical when M&A transactions happen, because if part of the due diligence, the acquirers would want to know, as Mike mentioned, what are the companies doing? Are you documenting this? Have you shown progress? And so we need to get everybody on board. Everybody needs to report against the same definition, so there's no apples and oranges in that analysis, and show how they have been good stewards of capital. But again, talking about resources and the size of the companies, I don't think the size of the company matters, because one could right-size the investments and the efforts. I'll give you an example with Silvercrest last year when COVID started in Mexico. We were in the midst of feasibility study to build a mine. And so the community all of a sudden communicated how nervous they were, and we were worried we're going to lose our license to operate. So we had to pivot right away and engineer on-site camp, procure testing machines, help the communities, and that added more than 10 million of extra cost. So we had to partner with our investors and explain why our CapEx was going higher. But they funded the project because they believe now that we actually secured the license to operate, and we can actually build a mine during COVID, and hopefully we can deliver it on time next year. So this is an example that even a smaller organization could do the right things, could measure the right impacts, and could quantify now the returns on for all partners. So for investors would be the time to cash flow, for communities is improvement of healthcare, and for employees is safety. So there's various components that we can talk about it. And now our expertise, we could apply to any other parts of the world or any other aspects of our engagements, and building that team and building that skill and tying it to measurable outcomes. This is why 20% of the incentives for our team are sustainability driven. So this is now part of our DNA. We do it right, we measure it, and we communicate it. So this is where we're headed. Another example, just how quickly even a smaller company can pivot, is at Golden Star. We're starting to do a shadow carbon emission tracking. As I mentioned, this is going to be a very big field, and we need to know what is that cost, and how can we leverage other opportunities and talk about energy improvement projects. And how's that going to improve the profitability? Now, if we improve the profitability, we can actually start investing in other technologies and partner with local communities and do better and turn more of our tailings into oil palm plantations. And so engage all that social periphery that exists in and around our minds to elevate the benefits for everyone and share that return for everyone. So I think those are going to be very important sustainability conversations. This is what will attract even larger companies to feel more comfortable with our parts of the world that perhaps are not common for them to be at. Mind you, in the mining industry, we are in very different and very challenging parts of the world where we know how to manage those risks, but how can we improve the returns for all stakeholders? I think this is where the conversation needs to be. And if a transaction could help in that process, I think the combined entity will be a very favorably looked at. And so the cost of that combined entity will improve. And that's where we could attract more investor interest and more investments. As you know, mining is a very capital intensive industry, and reducing the cost of capital is crucial for the long-term success and sustainability of this industry.
So Andy, thanks. Thinking about that risk point that you make, and having talked a little bit about the importance of ESG now in the M&A context, for the reasons you mentioned, I'd like to just pivot it for a second to dealing with some of those risk points, and you touched on a number of them there. The first is, anytime we're investing or making an M&A trade, we're creating a bit of a flashpoint. And our sense from a legal perspective is that not only is there a diligence exercise to ESG in the M&A context, but it also creates a bit of a transactional flashpoint for stakeholders, governments, for advocacy groups, and there is heightened risk around some ESG issues, I think, in the M&A context. And in addition, we've heard about some of the challenges in terms of standards, in terms of some targets and operators actually managing this issue themselves and having it available to potential buyers in a way that's useful. So thinking a little bit about the risks, thinking a little bit about transaction execution now, wanted to chat with the group a bit about how your firms approach those issues. And Ian, maybe I'll start with you. You assess mining companies as a business. What is your first step in assessing targets ESG risk profile? Thinking about your earlier comments about materiality, how as a practical matter does Backroad come at the ESG diligence question?
Yeah, it's a little bit more difficult under COVID, but we always start by going to leadership and meeting and interviewing with leadership, because ultimately this stuff starts at the top and the leadership sets the culture, and it's so important, because if that's off track, it's hard to get back on track. If that's on track, then there's a real opportunity. So we have discussions with leadership management. What we would normally do is then get on site and do on-site verifications to really see if what's happening on site is consistent with what we heard in the conversations. That's a little bit more difficult now. It's not impossible, but it's a little bit more difficult. So that does make some of the other things we're going to talk about a little bit more important, of which disclosure is one, and we're going to keep coming back to this theme. The other thing we do, of course, is external expert verifications of important things. So, we will, whether the company's done it or not, we'll do a material risk assessment of the risks of that particular company. So you can imagine a company in British Columbia might not have a lot of corruption risk, but it may well have a lot of indigenous or other risk in there. And we would really want to do deep dives into that and see what's occurred. In terms of disclosure, that also tells you a lot about the leadership and the culture of the organization. And it's not just about whether they're disclosing according to what is legally required of them, but it's whether the leadership has the foresight really to be seeing what's going on more broadly in society and in the communities in which they're operating, and are really able to work to that as well. It can tell you a lot about whether the business is in control or not. I hear Mikhail's comments around the number of ratings agencies, and I couldn't agree with him more. But actually, if you go to the material risks themselves and look at those material risks and go to the root source of what's fueling legislation and what's fueling the driver of performance, actually, generally, it's a small number of things. So, for example, if you want to get tailings right, go and look at the global tailings standard, the ICMM, UNEP, and UNPRI have put out. It tells you everything you need to know. Do that, and you're probably on track. If you want to understand around Indigenous rights, the United Nations Declaration on the rights of the Indigenous person, which is now starting to be enshrined in law. You've seen it enshrined in BC last year, I think, or the year before. That gives you good guidance of what you've got to do. So again, I come back to that materiality. If leadership understands its business, it'll understand what's material. It'll get to the root sources of what it needs to be putting in place. If you're operating in a high corruption risk country and you haven't thought about US Foreign Corrupt Practices Act, or you haven't thought about EITI, then I'd be deeply concerned about making an investment with you. I think these are pretty obvious things that you would expect executives to be all over. I think there's another point though, which is that we don't just want to crap all over companies that are not doing this right. I mean, ultimately the world needs these materials. We want to make investments, and we want to work with our investee companies to improve their performance. we understand the limitations on resources, and we understand that sometimes these companies are very technically focused in their management and leadership, may not have the broader set of skills. So I don't think it's right also that we just say we're not going to invest. I think the right conversation is, look, yes, we'll invest, and these are the things we're going to bring to support you and ultimately improve your business. And at Pacific Road, we've worked pretty hard on putting in place a series of policies and standards that the companies can use that link to what we think are, and what most other people that understand the areas think are going to be the critical areas. So for example, on tailings, it points to the global tailings standard. We don't have anything else. We just say, that's what you need to be looking at. But it does give the guidance to the companies of where they've got to go. So that's important. So really, that's our framework. But I do have to say, Michael, that in a COVID world, this has got a lot more difficult because we can't just jump on planes and get on site and verify things. And so it does make some of these other things like disclosures that little bit more important.
Julian, any thoughts? I'm thinking a little bit as your perspective as a provider of finance, either with your private equity hat on or as an alternative finance provider.
Well,
I hear you talking a little bit about standards and putting those two portfolio companies. How do you guys see it?
Well, first of all, I think also the honesty of the counterparty is super important. Reputation counts. And with time, we've all been in this industry together for a while. You start to know the animals in the zoo, and there's some people, you don't want to do business with. And so I think that is that's one thing, we just won't work with those people. But I think what's increasingly important, and it's important to us, are these carbon curves. These, everybody was fixated about the cost curve. Now I think people are going to be thinking much more about where they sit on that carbon curve. If I was a junior, I would make sure that I was, very well positioned on that carbon curve, because that's going to be super important now in making sure that you are going to be sustainable, that you're starting in a good place and you can move to a better place. If you're starting right at the end of the carbon cost curve, and that may be a function of where the power in the country comes from, or your strip ratio, or whatever, it's going to be very difficult. And then the other thing that we are super fixated on everywhere is the specifications. Purity, less contaminants, less pollution, is going to be increasingly important. Of course, we don't disregard, as I said, the E and the S, because those cannot blow up in your face. But beyond that, if I was a junior, I would say be pure, be clean, be involved, be honest, and be involved in some sort of technology to differentiate yourself.
Thanks, Julian. I think maybe just one more quick one before we wrap up, and I take a minute to thank all the panelists. But Annie had made the point, about us operating in a very global environment. All of the folks on this phone call do. Mike, Kinross has operations in a very diverse set of jurisdictions. Is there any particular ESG focus that comes from international operations that informs how Kinross thinks about M&A diligence?
Oh, yeah, first of all, our focus in all these jurisdictions is about getting it right on the ground and building on that. You're obviously a guest in many of these jurisdictions, and so you have to behave accordingly, even though you're a large investor with a large local workforce. I think the fact that we're global, it does give us a very good perspective across the different types of issues and all the different scenarios that you could face investing in different climatological environment, different political environment, social environment, whatever it may be. And what it does do is it opens our eyes probably more to more investment opportunities because we have that perspective and can benchmark the one against the other, as opposed to a company that's perhaps only operating in one jurisdiction and is comfortable there. So it means our risk tolerance is probably a little higher as a result of that, but also the sophistication with which we assess opportunities has grown through experience and exposure.
I think it's a great place for us to wrap up, just because we have run out of time for this session. But I do think it is a reality, and it just brings home the truth for the mining sector. It is an extractive resource. It is an extractive resource sector. It is an industry that has to deal with these issues, and it is an industry that, by definition, has, or maybe not by definition, but certainly by circumstance, is truly global. And really, I think as ESG becomes a bigger and bigger focus, it becomes a bigger focus for the mining sector, and therefore is going to have impacts throughout, the M&A life cycle. Assessing deals, making determinations about strategic deals, and then executing on transactions. So with that, I'd like to thank all of the panelists, Ian, Annie, Julian, Mike, Aidan. Thank you very much for your time today. And I hope everyone's managed to glean a few pearls from this and enjoys the rest of the roadshow. Thanks.
Absolutely. Thank you very much.
Thank you.
Interesting discussion.